Welcome back to Behind the Checkout. I'm John Lunn, founder and CEO of Gr4vy. Today's a topic that's puzzled a lot of folks in the industry, particularly merchants. And honestly, it's probably about time we talked about it. So question is, why is interchange still higher for card not present transactions, even though online payments have become more secure than they've ever been before? So to help me unpack this, I'm joined by Anand Goel, founder and CEO of Optimized Payments. Welcome to the show. Let's dive in.
Good to see you, John, and good to be with you.
Let's start really simple question. What the hell is interchange?
So, good question. Start with the basics. Interchange is the fee that merchants pay. They go to the issuing bank that issue that specific credit or debit card. And as you know, interchange pays for the cost of money for the bank and for the risk that they take on in extending credit. But it also is a big revenue generator for the banks. And for us as consumers, it also pays for all the miles and the points that we love for using our cards.
Got it. So there's different levels of interchange and there's a number of bits that go into the calculation. But generally speaking, and at least in the US and in most markets, interchange is higher for a online card not present payment than it is for, let's call it an offline or in-person payment where you hand over a piece of plastic.
Yeah.
And it's over the years, it's limited perhaps the innovation that could occur in store, right? Like you've seen people run experiments walking around with tablets trying to do kill the line at checkout, and it's always been a bit of a problem because of the technology that's available. And it's definitely easier to integrate to a card not present rail than it is a card present rail. But it's always assumed, in my opinion, that a card present transaction, a transaction where you walk into a store and hand over a card, is more secure and less risky than a card not present transaction where you do it online. And anecdotally, my partner doesn't sign her cards, right? And I've given a crap about it for years because I'm a European. But honestly, I give my kids my credit card to go and buy bubble tea when they need it, and no one ever checks. So why is interchange harder? How is that more secure than 3D secure and everything else added together on it?
There's a lot there, John. So with the implementation of EMV in the US, card present transactions have become a lot more secure. And you're probably more familiar with it from being from Europe, that they've had EMV for a long time. And then there's also government, EU regulation that regulates credit and debit interchange fees. And that's quite different in the US. The US, we're newer in implementing EMV, and that has significantly reduced counterfeit fraud. And a lot of that fraud has shifted online. So when you look at the risk profiles, even with implementation of 3DS and tokenization and device fingerprinting, those implementations aren't ubiquitous in the marketplace. So as a baseline, card not present transactions are more riskier. And that's where more of the fraud occurs than card present transactions. Because with card present, whether you're tapping or you're dipping, the card transactions are secure, where the issuer has the liability. Whereas with card not present, it's the merchant that owns the liability.
Let's be honest, like a card with no signature on it, held by a different person working into a store, versus you're online, your device is fingerprinted, you've got a passkey running, 3D secure has verified you with your bank. How is that more secure? Like how is that? I mean, I don't get it.
Right. Well, so in your retail example, if someone loses their card, yes, someone else could use it, and until that gets reported and deactivated. And in such an instance, the merchant isn't on the hook, because the liability for all chip EMV cards shifts to the issuer, even in the case of fraud, because that's just the way the way the industry's set up and evolved over the past number of years. Whereas I agree with you with the modernization of e-commerce or online payments, risk has come down. And I think the gist of your the question is, given the modernization and and maybe the greater use of uh, you know secure transactions or 3DS technologies, tokenization, the costs haven't come down, right? And like why? Maybe the question is like, why is that?
Yeah.
Yeah.
Exactly. I mean, is this a question of control? More about control, less about risk and fraud? Is it?
Yeah. I think I think it's I think it's probably both. Um, there's no doubt that interchange structures reflect both security considerations
Uh-huh.
and just the market dynamics. We're dealing with market dynamics that have been created over, let's say, the last 50 years, because there used to be, just card present and card not present. With card not present, we had MOTO, mail order, telephone order. How often do we see people doing mail order, telephone order transactions? Not very much, right?
Yeah.
Where there wasn't a lot of security. But now with online transactions, yes, things have gotten more secure, but also the industry has been slow to evolve because of just infrastructure as well as sort of the incentives in the marketplace. I mean, with having higher interchange fees for card not present transactions, there are definitely players that benefit. And are they eager to make those changes? Probably not.
Got it. So from a data perspective, and Optimize is very much into the data here. So what does the fraud landscape actually look like across card not present and card present channels? Issue is doing dynamic pricing at the moment based on risk levels, or is, as you said, infrastructure is kind of creaking a little bit. Are they not able, like, can they say, merchant A, you're doing all this cool stuff with risk and fraud, we're going to give you a lower interchange to merchant B that's doing nothing? Is that in place? Is that happening? And I mean, that's a big question, right? But
Yeah.
let's start with cross card not present and card. What does fraud actually look like today, and where does it sit?
So broadly speaking, the fraud landscape today, there's been significant shifts. Card present fraud has dropped substantially over the last number of years since EMV adoption, and card not present fraud remains relatively higher. And though it's stabilizing in certain merchants and maybe certain industries that have e-com industries or card not present, verticals where companies have adopted 3DS and tokenization and SEA. The challenge when you have a big broad bucket like card not present, right? It's fraud isn't uniform. Because it can vary based on merchant category code, geography, because you have certain markets like Europe where they mandate SEA, and even transaction size. Because we find that even in card not present transactions, you don't see a whole lot of fraud with small ticket transactions because there's just not a lot to be had, right?
What? Yeah.
Where you see fraud with high ticket transactions. So to your second point, given that there is, varying degrees of fraud controls in card not present, is there such thing as risk-based pricing? I mean, today, unfortunately, not. No. Um, Even though issuers have so much more data than they ever had before, where they theoretically could consume that data to make risk-based pricing decisions, the rest of the industry, the card networks, haven't evolved to basically give merchants the benefit of risk-based pricing. And I think that's an area of opportunity, right? Where like everyone is subjected to the same rates, regardless of the technologies you implement, where there's probably, ecosystem incentives. So if you give merchants incentives to implement certain technologies, they're more likely to do it and make the whole ecosystem safer.
I think like the interesting thing that's happened over the last few years, particularly around things like 3D Secure, et cetera, is that incentive was put in place to, basically do 3D Secure as liability shift, right? That was part of it. It didn't really work until they mandated it, right? And then it was almost a case of like, you have to do this now. But we've seen liability shift definitely being an attractive thing to merchants. But then then in the same, probably not going to dig too deeply into VAMP today, but the new VAMP requirements have almost said, yeah, you've got liability shift, but you're still responsible. And so there is, it's kind of give with the carrot and stick, like happening at the same time, really here, just to get things to go the way they were. But feels a little bit one sided. Feels a bit like on the merchant to do it.
Yeah, I mean, it clearly, the way the ecosystem is set up today, not only does the merchant own the liability shift, or sorry, they own the liability of fraud,
Uh-huh.
um, but they also have to pay higher interchange fees. Like, theoretically, shouldn't the higher interchange fees be offsetting, the increased risk fraud? But no, I mean, it is very one-sided. Even though, I mean, we work with a lot of merchants, I'm as a third party kind of sitting and looking at the system as a whole. And I think, even as new use cases are developing where we're paying with our mobile phones, so even though it may not be an NFC transaction, it is an authenticated where you're using biometrics to get into your device, and you're paying for a card not present transaction on an app, right? For online, and you're shopping online. I would think that's a lot more secure transaction using a mobile device. But merchants are being rewarded for that, in the form of either liability shift or in the form of lower interchange fees. So I think that's a significant area of opportunity where the merchant community needs to continue to lobby and push for, with the card networks, some changes in market dynamics.
Yeah. In some markets where I mean, Australia is a good example where there is click to pay, there are passkeys, then they are definitely starting to, some of the card associations starting to look at, not interchange itself, but yeah, they're starting to look at a lower fee, and they're also starting to look at liability shifts, which is interesting. So there's hope here that we might get there. All right, so let's talk a little. One of the things that we talk about EMV, right? So we talk about EMV, but I can't remember the last time I actually used my plastic card because I'm a Google person, so I have a Google Pay. Is that EMV? If I'm using Google Pay, is that the same level of security? Is that different? Why is that different from an online payment?
So it depends on how you're using Google Play. So I'm an Apple guy, so you might have to educate me a little bit. But so I got my phone right here. I've loaded all my cards on my phone, when I'm at a checkout, if I use my phone, I'm using NFC, right? NFC is the same thing. If I had the card in my hand, I dipped it or tapped it. So those are both card present transactions, and the merchant is going to get the exact same interchange rate, whether I used your card or my phone, because I'm using NFC.
But it's not EMV, right?
It is. It is, with Apple. Apple worked with the networks and the issuers. It basically, I don't know the way the technology works, but it's considered a secure transaction.
Yes.
Here, it is lumped in the same category as EMV, right? As a card present authenticated transaction.
Yeah, I know as authenticated, it's like I look at it and I think I'm doing that pretty much the same thing online or with Apple Pay or Google Pay, but I don't necessarily have the phone, and maybe passkey solves this, right? Because passkeys should say you've got the phone, here's a key sitting on it, you are remote, but you have the device. So maybe this gets us there, and maybe we've got a feature where that happens. But at the moment, again, feels like the infrastructure or perhaps hasn't caught up with the technology quite yet on this side.
Yeah, I mean, I'm with you there, because if I have my phone and I'm using an NFC transaction versus going on an app and making a purchase, they're both getting authenticated because it's through biometrics, and I'm in my phone. So I think your thrust is like, why are there different fees if I'm doing an NFC versus an in-app purchase or something?
Yeah.
And I don't know if I have a great argument for you, man. I think I agree with that there's a lower risk profile of that in-app purchase or online purchase through my phone, and the issuers and the network should give it consideration. And currently they don't.
Interesting enough, so we work with a lot of merchants over in Australia where the interchange is very similar actually between card present and card not present, because the interchange rates are so low on card not present. And what we've seen is a lot more innovation on the merchant side around what you can do in a, say, customer present environment, because it's not necessarily card present, but customer because now if your interchange rates are the same, you're no longer tied to a point of sale. You're no longer tied to a physical device that has to scan a card, etc. And it's been a matter of frustration of me of years that like so many cool things we could have done in payments, right? If you didn't have to go and walk over to a machine and tap a card or stick it in the side or swipe it or whatever. Are we slowing down innovation unnecessarily here?
Yeah, I mean, even in Europe, where you have the same interchange rates for debit and credit at 20 and 30 basis points, right? And it definitely spurs um, creativity and different use cases, and of course, innovation. Um, even in the U.S., I know there have been pilots of using your phone to pay for at the gas pump, right?
Yeah.
Not an NFC transaction, but a mobile app that would basically activate the pump. You approach a pump using geolocation, and knows you're at the gas station, you're at pump 4, and you can activate it, and you don't have to fill, um, fill out a card. And some of those initiatives have been slowed because of costs as well as liability shift, and on all of that. So I think you can make an argument that some of these artificial artifacts have been created over the last 50 years. They persist and they need to change, because now you just because of the advancement of technology, you could be customer present but card not present, right? As you mentioned, what additional sort of things can you create, and experiences can you create if you didn't have to adhere to these economics that have been created? Um, I do hear a lot of that conversation, like at industry conferences and forums, and I think is just because of the industry incentives. The issuers at the end of the day, they make higher interchange fees, right? And they're able to these big financial institutions, big banks, they're using that money to pay higher sort of rewards. You talked about Australia and we talked about Europe. And when you think about the US, we are even though debit volumes have increased, we're still a very credit card focused society. And we love our cards. For a lot of us, it's the points, the benefits that we get from using our cards. And it's hard to get consumers who are so stuck on those rewards, and they do cost money, whether it's miles or cashback, what have you. And the issuers, they want to continue providing those incentives, but they will still want to make a margin. So they have to keep interchange fees at 200 basis points. That's the historical sort of legacy thinking. Does it need to be that way? No, clearly not.
I know, and those benefits are shrinking, right? If you look at the numbers over the years, your credit card's probably less attractive than it was even last year. Like I have one that they just completely changed the benefits on it, and it's frustrating. But so there's the thing, like there's the new payment methods coming through, right? We got probably not buy now, pay later, but you've got things like that, bank to bank payments and others. Could they just jump over? Could we end up just using those because they're going to be cheaper? Could we end up with an in-store card customer present solution that's, got lower interchange, and essentially maybe cards just end up being used in store only because of the low interchange and other things take over online?
One thing we are seeing with a number of our clients is incentives or disincentives that drive consumer behavior. So a couple of examples is I use T-Mobile for my phone provider, and forever I've used my credit card to pay my T-Mobile bill auto pay, right? And because I'm paperless and I get the auto pay, I used to get like a $10 discount. And I think this is about 2 years ago, where I got a notification, hey, your benefits is going to be significantly reduced or go away if you use a card. But if you use ACH, you can keep the $10 discount. So clearly, like for me, I did the math, like the $10 was better for me. So I switched over to paying via ACH. And the same sort of thing over the last couple of years has been happening with other providers. So my insurance company, home insurance company, they did the same thing. I migrated to ACH. Then I'm seeing in certain industries, they're surcharging, if you use a card. But if you use a debit card, obviously there's no fee. So I went to a restaurant and they wanted to charge an additional 3% because I used a card. So I'm seeing more and more of that. And I think this is one of the effects of sort of unchecked increases of the cost of payments. Both the networks have been increasing scheme fees over time, and the interchange has been increasing on credit cards over time, and this causing the effective cost of payments to increase. And that dynamic, merchants are feeling it more and more, and they're like, "How do I get out of this cycle of paying all these ridiculous fees?" And the consequence is there's more surcharging in the marketplace, just even in retail environments that
I was in Australia the other day, and they surcharged my hotel. My hotel at the counter with a card present transaction, and I asked her how I could get around that. They said you'd use an Australian debit card. So essentially, as a foreigner, I was having to pay a surcharge.
that, and that's crazy. And I think that this is going to grow unless the industry imposes some sort of self-control to reduce the rate of increase or actually mitigate some of those increases, that have happened over time. So I think the innovation is going to come from these alternative payments, is these alternative rails with a combination of incentives and disincentives.
Interesting. So if you were to sit down and redesign interchange right now, if you got a clean sheet, and you could redesign how it ran, how would you do it?
If I was a merchant, I would I would do it quite differently versus if I was an issuer. But I'll kind of keep my current role as optimized payments as an independent sort of party in the marketplace, right? As such, I would recognize the value that the system provides. I mean, the card networks and the issuers, they do provide value. They provide a system that facilitates fast transactions and funding to merchants, and consumers can spend more money that they don't have to carry with them to make bigger purchases, and merchants benefit. The whole ecosystem benefits.
Yeah.
But today there's greater sort of benefits on the network and the issuer side than there are to merchants. So I think so it's kind of, if I could kind of start all over again with the payments ecosystem, what I would do is and I was redesigning it from scratch. I focus on a couple of guiding principles. One would be transparency, two is risk management, and the third would be incentives for security adoption. And they kind of go together. Transparency, making it, allowing the merchant community to understand what goes into pricing, right? The reason these rates are higher is because of XYZ. And then to our earlier points about risk-based pricing, if you are a merchant that has implemented all these security measures, you're doing network tokens, you're doing SCA, 3DS, you should pay a lower fee and than someone who hasn't done those things. So that's the incentive. And then maybe the third and the last thing would be, security adoption. Like if you implement these things, your fees will go down. If you don't, they will be higher. So I think those would be the three guiding principles that I would use to create a brand new sort of ecosystem from scratch.
I think something interesting that an experiment that I ran in a previous role with one of my portfolio companies was who pays for incentives, right? That was the interesting thing. And we by having merchants incentivize behavior, we actually managed to move 90% of consumers using this app from one side of the road, one gas station, to another side of the road, to a completely different gas station, by giving cash back on fuel, right? So, and that cash back was actually paid for by the fuel station on the new side of the road. It wasn't paid by the card. And so I don't think the consumer really cares where the incentive comes from. So I wonder if that model where perhaps there's an incentive to use certain cards on certain websites, and the incentives are shared by, not necessarily paid for just purely by interchange, but could be paid for by merchant discounts, etc. There might be a way to break this, this mold a little bit and move it to really what the consumers care about, which is getting a good deal.
Absolutely. And I think I've seen some examples of that in the marketplace. I don't remember the name of the gas station, but I remember this particular gas station had an app where you could load credentials, like you could load your banking credentials into the app.
Yep.
And they basically gave you a discounted fuel price if you used, those credentials, banking credentials versus cards. And then I saw a grocery store, I think it was Myers grocery store, where, when you sign up for loyalty cards at different grocery stores, uh, this particular loyalty card had a place where you can put in your bank information. So they would link your loyalty card to your bank account. And if you pay, when you checked out and you paid, put in your loyalty card information and you authenticated whatever, and if you paid with their card, you'd get more Myers points than if you used a card. So can you imagine, like, all these different loyalty programs that different, merchants and companies have, if they incented you with, it doesn't have to be always discounts. It could be just more points.
Yeah.
If you use preferred payment methods. And not only does that reduce costs, but there's also risk, and with faster payments, it may also facilitate you getting your money faster too.
Yeah. I think there's all kinds of interesting things, particularly in the grocery space. I think one of the we're a lot of people are living on hard times at the moment, but often, it takes a while to pay off a credit card bill, etc. Like you go and pay it, it happens on a certain day of the month, but maybe you get paid on a different day of the month and you still need groceries, right? A real-time payment would, there's no, in real time if that consumer has funds and that consumer might have been paid 10 minutes ago, right? And might need milk and diapers for the kids, right? So, but I think there's a lot we could do there to make actually a better, more inclusive system. And it's incentives, but as you say, there's also disincentives that could be used there as well. So overall, a lot of interesting things could happen. But look, that's the dream state. Always trying to ask towards the end of these sessions, like 5 years time, where are we? What does this look like?
Yeah, I mean, I'm excited about some of these alternative payments that are being experimented. Whether you're using like a Venmo or I don't know about like crypto. I'm a bit slow on that with this mass merchant adoption, just the time it takes. But when I think about where does the source of value come from? It comes like credit. It's, someone's extending you credit. You can have prepaid cards, like money loaded into some vehicle. It could be cards, it could be PayPal, like balances that sit somewhere, or it could be accounts, bank accounts, right? And if they're with pay by bank, and now that you have, services like Plaid, where you don't have to give out your banking credentials, they can facilitate the linking of accounts, and you can check someone's balances. You might get a sense of, I think there will be other services that could be built on top of it where when they're going to be paid, when they're going to have balances. So I think there's tremendous opportunity to tap into pay by bank and disintermediate some of the card networks over time. They're always going to be part of the ecosystem, but I think they need market pressures to come to heel a bit. I don't know about government regulation. They're always slow. I mean, there's the CCA, Credit Card Competition Act. I think that would be tremendous and awesome for the industry because that would force change, but I wouldn't hang my hat on it. I think some of the things that our industry is doing with pay by bank, I'm excited about that.
So basically what we're saying here is, if it doesn't change, the industry will move and go somewhere else. So that's what we're saying.
That's it. Yeah.
Well, really, really appreciate your time today. Hopefully hopefully a lot of the angst, the questions we've helped not answer, but highlight, I would say, where change needs to happen or should happen. But really appreciate your time today, and thanks for joining the podcast. If anyone has any questions listening, we're happy to forward them on if we can't answer them, or send them over to Anand to get an answer for you. But again, thanks for joining the podcast today, and look forward to seeing more of you.
Thank you, John. It was good seeing you.
Cheers.
Cheers.